Hey everyone. In today's episode, I'm going to do it a little bit differently. So what I'm going to do is just over the time, I've learned a lot about investing in property. Obviously wins, fails, things you learn from other people, things you learn from more successful people, things that you wouldn't think of that tend to happen over time. And what I've done here today is I'm going to discuss 10 things I wish I knew before investing, because there's mistakes I've made and mistakes I've seen other people make that are very regular. And they cost a lot of money in the long term, and some people overlook them. So it's really important. So in today's episode, I'm simply just going to list 1 to 10 and the things that you need to know about each of them and why it's important. So anyway, let's get into it. Let's start with why strategy is everything in property. Now, I can't tell you how many times I've spoken to someone and they come up and they'll say, look, longer term wealth is everything to me, and I want to make good money and sustain my family longer term and set myself up for the future. And then they go out and buy a small unit in a shitty area and they wonder why it hasn't done the same growth as a house. Now, well, I'm not having a crack here at the growth necessarily. It's not the growth component I'm having a crack at. The thing I'm having a crack at here is, why didn't you research it or speak to someone who knew what they were talking about in the first place? Now, realistically, if you want to take it to the next level, you're probably going to need a few people around you. One is absolutely definitely an accountant. Absolutely definitely need that. And don't get an accountant who doesn't have any money. The average accountant only earns like $150,000. You need an accountant who's worth like $20 or $30 million. Like, they'll cost a lot. They'll probably cost $750 to $1,000 an hour, but I'm telling you right now, you can multiply what you'd make out of that accountant by probably 2 to 3x minimum, so it's worth every cent you pay with them. The second person you'll need is, in my opinion, unless you literally spend 10,000 hours a year in the market, is a good buyer's agent, because they will know where to buy. They'll set up the strategy correctly along with your accountant, and you will have that absolutely perfect. The third person you will need as well with that is also a good mortgage broker. Now, accountants and mortgage brokers with your buyer's agents who know what they're talking about will structure themselves correctly, and this will help your long-term game. So, different people should invest differently depending on their time, the stage of their life. And also, not only that, it should be structured differently too. Now, if you're looking to pass on an asset to your children, for example, and you don't want to, for example, have to have them sell it, you probably should consider buying it in a different structure other than your personal name, especially if it's very cash flow positive, because there's massive tax benefits to that as well. So that's just something with strategy. I've seen this fall over a lot of times. I've seen people cross-collateralize portfolios as well. So that's why strategy is everything in this example. But make sure you have that correctly done before you even consider buying a property. That needs to be done ideally at least 2 months before you even buy a property, idealistically, and you need to be speaking to them in the first place. So strategy is everything. That's point number 1. Point number 2, buying a property costs more than you think. A lot of people think that you can just buy a house, I have a 20% deposit, good, yep, I'm good to settle on a property tomorrow. There are all these costs that you don't even consider when you go to buy a property. Let's have a look. So I've broken it down into a couple of things. Now, deposit-wise, you're looking at 10 to 20% of purchase price. Now, obviously, the lower that price is, the higher LMI is going to be. So the lower deposit you have, the higher LMI is going to be. 20% you don't pay LMI generally, but that's something you probably should consider. Now, for those people that say you only need a 20% deposit, you also need stamp duty, and that's 4 to 5% of the purchase price, depending on the state that you buy in. So New South Wales and Queensland, for example, are around closer to that 4% mark. South Australia and Victoria around 5%. So, you can't buy, if you have a $200,000, you want to buy $1 million house, you need to add at least probably $50,000 to that for stamp duty alone, even in the cheaper states. Settlement costs. That's your pest and building legal costs. The rest of it, you might have a few other things you might want to do, maybe surveying. You might have, for example, plumber you might want to send out. I generally leave 0.25% of the purchase price for that. That's realistic. And then you've got LMI as well. So what I've mentioned on the bottom here is, with LMI and a 10% deposit, to settle, you would still generally need 16 to 18% of the property value. And the reason for that is because even if you capitalize LMI and you don't pay it, what ends up happening is that deposit ends up being about 12%. And then you've also got the 4 to 5% of the stamp duty on top of that. And also you got the 0.25% settlement cost. So just to be realistic with everyone, if you've got a property, and especially if you want to do it properly and get a buyer's agent here, you're probably realistically looking at somewhere between 16 to 18% of the asset value to settle on a property. That's just being realistic about that. Capital growth is far more important than cash flow. And I cannot tell you how many times that I say this to people. Obviously, you need to have enough money to survive, but capital growth is cash flow. And the reason for that is because cash flow or yield is a percentage of the asset value. Hence, you want the asset value to go up. Now, I'm gonna basically do this with a direct example, and I'm going to compare a crappy suburb called Logan. It's probably an area that a lot of people, buyers agents, will hate me saying because they suck at their job. And I'm going to compare a good suburb in inner north of Brisbane called Wilston. This is the price here you've got in the 1980s. So you'll see here they're similarly priced. You could probably even argue that Logan's a little bit more expensive than it actually. But anyway, same street, similar price, quiet street, similarly priced in the 1980s. Now, this is the price today. So you've got them both around 40 or 50 grand in the 80s. Logan now about 650,000. It's about 650 to be fair today. Wilston, to be fair today, it's about $1.9 million. So one is triple the price just in the space of about 40 years. And that's doing absolutely nothing. That's just buying the same kind of property in each suburb, which is just insane. So I should let everyone know too that Logan's yield at the moment is still about 4.5 to 5%. And it's about, $500 a week is realistic there. Wilston's, for a standard 3-bedroom home, like you're probably seeing here, is about $800 to $900 a week. So you're earning literally almost double the rent as well. It's about 80% more in rent, and you have triple the asset value. So you could do nothing here and literally own triple the asset value and have better cash flow than you would in Logan. So that's why you don't buy assets for cash flow. It's a rubbish idea. It doesn't work. And you're going to hate yourself longer term because everyone's going to be richer than you who bought in the right area. So point number 4, capital growth is way more important than cash flow. Point number 4, you must be able to afford the expenses with a 25 to 40% additional buffer or 3 to 6 months savings. Now, what do I mean here? So basically, look, 25 to 40% is conservative, but it's especially apparent when we're at the peak of the market and the bottom of the interest rate cycle because things become more expensive and inflation generally takes off. So that's the more conservative way. 3 to 6 months saving is the more risky way, but it's not too bad either because you can sell a property within 3 months. But the reason you want to do that is because if you ever fall behind on a loan or anything like that, you have enough time to sell the property and not rush sell the property. So you're okay in that sense. And the reason is because in times of hardship, you get people falling behind on loans. So here's a good example of it, right? You've got, after the interest rates have risen there, you can see the graph from, you can see obviously interest rates cut, then the percentage of mortgages falling behind going down. Once 2022 really kicked in and 2023 came about to 2024, it really kicked up. And the reason for that is simply because people at the time could not afford the homes and they overcapitalized. So that's the reason you need to have additional savings or a buffer. It could be a servicing buffer as well. You might have a 25 to 40% additional servicing buffer. That's okay too because you can afford it, right? But let's just be realistic. That's what you need to comfortably be able to do it. That's point number 4. Point number 5, maintenance costs will cost between $1,000 to $2,000 for a newer modern home, and then $3,000 to $6,000 for an older home per annum. And when I say modern home, I mean that includes a renovated home that is old, that is structurally sound. So that's okay. An older home, I mean, it is pretty fucked or pretty bad and it needs renovation. That's what I'm talking about. So a lot of people think I'll just do a yield calculation without doing any expenses. I'm telling you right now, these are the rough expenses per year. for properties depending on their age. So leave that in there, and I'm telling you, this will go up. Trades costs are going to continue to go up. We keep importing immigrants that don't know what they're doing, that are 0.5% of them are actually tradesmen. So there's a shortage, which means the same, actually there's more demand because there's more homes being built, but there's a shortage of tradies, which means more demand, less supply, so prices go up. It's very simple economical calculation, but just something to consider in that. This is a genuine cost. So that's point number 5. Maintenance will cost some money. Point number 6, new homes are built like shit. Now, I have builders, mates who are builders, family that are builders, and I'm not talking about you guys who actually do a good job and actually do it correctly. What I'm talking about here is your builders who either try to rip people off, use shitty materials, or your main project home builders that just turn over 1 million properties in a year and the quality isn't as good. So the perfect way I want to do this is just show you a photo of the actual grain in the wood they used to use, and this is in 1918, so this is just post First World War homes. So you'll see in the grain of the wood there's about probably 20 to 30 grain alone, in maybe even more in that grain there. In 2018 there's probably about 10 grain in that wood. So it's probably a third to a quarter as good as it used to be in these older homes in terms of the material they use. And what I should say as well is that 2018 one's actually very nice. That I'd actually even think that wood's better compared to today. If you look at 2025 today, what they do with wood is they grow this crappy wood for 1 or 2 years. They cut it down, they put it on a boat to China, chemically pop it out, then bring it back, and it's got 1 or 2 grain in it generally. So it's absolutely rubbish, the material they generally use today compared to what they used to. And worse off as well is what you'll find is the actual density of that new brick is crap. So your old red brick generally had if you called that a density of 1, your new shitty terracotta brick has a density of about 0.4 to 0.5. So it's about half as good as the old brick. So that's why you get all these problems in these new homes. You hear people saying my home's barking at night and that kind of crap. It's because it's just built out of absolutely awful material, and you should never buy one of these. So don't buy one of those newer homes that are built by someone like a project home builder or a mass builder or someone who just wants to do a cheap deal. I do it 20% cheaper than the guy down the road, because your home's probably going to be out 600 mil on the floors within 6 months, which is what I've seen happen before. So point number 6, new homes are built like shit. Point number 7, smaller deposits or LMI is worth it, but it's not linear or applicable to everyone. So this is, funny enough, a problem that I actually had, funny enough, with someone at a bank I actually used in one of my first purchases. So I was told at the time, and I had, registration to the Finance Society of Australia, accounting registration, and I also had finished a law degree at the time. So under a lot of the lenders, I could have actually been exempt from LMI. But I wasn't told I was exempt from LMI, even from someone working at a bank. So a couple of people that are exempt are accountants, doctors, lawyers, engineers, and dentists. Check with the bank what kind of proof you need for that. They're all a little bit different sometimes. Some just need to know that you're working as an accountant. Others might need a CA or CPA. The other thing I want to mention is smaller deposits are worth it because you can get into the market. Often you can capitalize your LMI, which is good, but it's not done in a linear fashion. So you'll see here, basically from about 82 to about 84%, there's quite good LMI there. Then right up from about 88 to about 90% as well. It's not too bad, especially at 90, but it goes really up from there. So there's all these different percentages of a deposit that you should kind of use and know that are actually more favorable than others. So that's just something to consider in terms of, LMI and also who can get it. That's point number 7. Point number 8. Now, this is one that a lot of people have probably overlook and don't understand. And I've learned this probably the hard way sometimes. And that is tree roots are a plumbing nightmare. Look, the way I learned this is I bought a house in a Newcastle in 2021. It was early 2021. And there was a tree that was outside. It was actually outside of my boundary, so I can't do too much about it. But what basically happened is the tree root came in and it grew through some of my pipe and it kind of like snapped it. Now, council did fix it because it was a council tree and it wasn't on my block, but Basically, the issue here is I'm saying if you have two properties and one has no trees on, the other does, buy the one with no trees, because they are absolute nightmare for anything you want to basically run. It could even be like gas piping. Like it's not that they'll crack through it, but they'll make it a nightmare for anyone to fix it if you have any problems or anything like that. It can be a problem even, for example, for cabling running through maybe your backyard or something like that. It's no good for any of that. And I mean, a lot of that plumbing work that needs to be done when a tree root gets in it isn't a cheap exercise. You're going to have to dig up your backyard, and it's probably at least a $5,000 job or something like that. So it's not a good idea if you have trees all over your property. Yeah, you might be a greenie, but it's not a good idea if you don't want to spend your last paycheck just fixing a tree. Like idealistically, you want to get rid of all the trees on your property. Like I like the environment, but it does not match up with plumbing. I'm telling you that right now. It's not a good idea to have a lot of trees on your property. So that's point number 8. Point number 9. Demographics drive markets, especially diversified economies. What do I mean by this? So demographics really are the forefront of where capital growth comes from, because if you have people who can afford to live in a market and pay more money for properties, especially if they live there long term and they've got the continued equity built up in the suburb, they can then continue to push the property up. But where I mean here is with what diversified economies is, somewhere like a mining sort of suburb of Perth won't be good, because if mining goes down and you've got 80% of the suburb living there because they're FIFO workers, right, it's going to be greatly affected. Whereas if you're living in a fundamentally strong suburb of Sydney, Melbourne or Brisbane, where you've got, let's say, education, government, medical, research, engineering, construction, trade, what's another one? Teaching, like every industry you can think of possibly in a suburb, it's going to be fine if one industry goes down. And what happens there as well, if you've got especially business owners that buy here that tend to be wealthier, it pushes the suburb median up. So what you'll see here is you'll see average statistics might not look like the suburb is going up in value, but the only one who is actually relevant to the suburb is those who are mortgaged and buying into the suburbs. So your affluent suburbs, particularly in your areas of Sydney and Melbourne, you've got a lot of people who are just buying within a suburb, upgrading. So they've got small mortgages, and you've also got people that buy them outright as well. So I think it's something like 62% of homes above $4 million in Sydney. So this is houses are bought outright in cash. So not many people know that. But these suburbs, the inflation does not affect them. So that's what you want to be buying. You want to be buying good demographic suburbs with diversified economies supporting them. That's point number 9. Point number 10, and it's my favorite one to go on about because I go on about it all the time, and that is do not listen to advice from broke people. And I especially say that from broke people who are over 40 years old or 50 years old who had the benefit of having house prices that are 3 to 4 times income and buying them, and then not understanding how, if you were born in that generation, you knew what you were talking about, you should be worth $10 million. Realistically, that's what you should be worth, because it was so easy to buy it back then and easy to get ahead, like so much easier than it probably is today in terms of real estate. So you get these people who say, oh, like I only own the house I live in. I think you should buy a property, and you should buy a unit in Hurstville in New South Wales. You should buy a unit in Box Hill in Melbourne, or in maybe, I don't know, maybe you should buy them in South Brisbane, a unit there. Or maybe even, I don't know, South Perth or somewhere like that. And it's the worst possible advice you can get. But the reason is these people haven't made any money themselves. That's the reason they don't know it. And so that's one. So the person at the barbecue or someone who hasn't made any money themselves, don't listen to them. And the second one you don't want to listen to is anyone in the media at all. Only listen to people who have actually done it themselves. Someone who hasn't done it themselves is reading about it and doesn't know it for a fact. If you wanted to be that $10 million person, you don't listen to a broke journalist who's on $79,000 a year, because they're not going to know what they're talking about. You need to listen to someone who's already made $10 million and is actually the $10 million person, because they will tell you what you need to know. So my final point is, and it's probably one of the most important ones, is do not listen to advice from broke people. I mean, like, obviously you can be friendly to them, but if they say something about finance and they're on $79,000 a year, don't own any real estate, don't own a $200,000 stock portfolio, well, what business do they have telling you about making any wealth, because they don't have any themselves? So that's the final point I want to make here. All of these are very important in terms of what you should know about property investing. The thing that I should say about broke people as well is I would even call some property investors broke. You have some that own 2 or 3 houses that are in Townsville, Dubbo and Albury or something like that, or other crap locations, or 3 units or something like that. And I mean, they are not going to do anything with that. They're going to have a below average wealth because they're all crap assets, right? Now, they might know about how to service a loan, don't get me wrong, but they don't know how to make money longer term. So that's another thing you probably should consider. But anyway, the whole fundamental reason I made this video for everyone is because all of these 10 points are really important ones that I've come across over the long term that do happen to affect people in a very bad way. So if you're going to avoid all of these things or just be educated about all of these points, I think you're definitely on the right track for property investing. And if that's something you're serious about and you have the money for it, I highly suggest you reach out via www.compoundinvest.com.au. I thank everyone for watching again, and I'll see you in the next one.